Okay, now after we look at the short explanation of this key task, let's look at the task each one by one in more detail. First is choose a capital structure. So capital structure is the combination of long-term equity financing and debt financing in which the company use in their international activities such as international marketing, production, or international expansion. So the capital structure is the source of money, source of financial support to for the company in their activities such as international marketing or production or expansion. Equity financing is the issuance of the company's stock, or in other words, they sell the company's shares of stocks to investors. So this is sometimes happening in many international public offering like IPO in stock market. So the companies shares their stock to the investors. Equity financing can also come from net profit that is not distributed as dividends to the investors. So after the company shares their stock, they sometimes also can get profit, and usually they don't use the profit to share it as dividends to the investor. Instead, they use the net profit from their equity to use it in many international activities like the international marketing or production or expansion. Of course, this decision has to be discussed with all the investors that hold the stock of the company. And debt financing is simply we borrow money from the banks or other financial supporters or institutions or maybe other investors. So they borrow money, in other words, they make debt for their activities. So if the company doesn't want to share their stocks to the investors, they usually borrow money from the banks for some interest rates in the future. So the international financial managers will determine which type of the capital structure to use. Is it the equity financing or is it the debt financing, depending on how the company plan to do their activities in international situation. Now, after choosing the capital structure, the company will raise funds for the firm. So raising funds, of course, this will depend on the type of capital that the company choose. So all type of fundings with maturity period is longer than 1 year is referred as capital. So we're talking about capital. Capital is the fundings here, okay? Now, fundings for international activities can come from three primary sources. We've talked about equity financing, and we've talked about debt financing. And then we have another intra-corporate financing. If the corporate or the company has quite amount of fundings, they can just fund their other corporates located in other countries. So in raising the funds in equity financing is simply they just sell their stocks. The main advantage of equity financing is that the company can receive capital without debt. So it means they don't have to worry about the interest rates when borrowing money. However, management also risks losing control of the company because the ownership is shared from the stocks to the many investors that buy the stocks of the company. So the risk is just the losing control of the company. And for the debt financing consists of mainly international loans. They have euro currency located in the Europe. They have foreign bonds or intracorporate financing. Debt financing can offer consistent funding, but they have to risk the interest and tax that may increase in the future, and this may result to a higher possibility of bankruptcy. So the company will need to really consider about the interest rates and the taxes that may change in the future as well. And after that, the managers will need to manage the cash flow after the fundings, the raising funds, and manage the working capital, the day-to-day activities. The working capital, this company's current assets. So after raising the funds, they will have their assets. And the cash flow is cash received from many sources, especially sales of goods and services. So this could come from the profit, or this could come from the net income, or from the equity financing. So international financial managers need to develop strategies in transferring the funds from the parent companies to the subsidiaries or branches in other locations, in other countries, to optimize companies' global operation. The strategies include some methods in transferring funds, such as trade credit, in-fronting loans, or multilateral netting. And then we have capital budgeting. The purpose of capital budgeting is to help managers decide which international projects can bring more benefit after receiving the fundings, because many companies they don't have quite plenty capital, they don't have many money, particularly in international projects where it requires very huge amount of money. And therefore among many projects, in capital budgeting, the managers will decide which project will receive the fundings, so that the company can invest in very valuable project. So not in every project opportunity. For example, fast food industry may consider the potential location of a new branch of subsidiary, level of competition, as well as the transportation access. Therefore, they can decide, oh, maybe this location is very good. Let's make a new branch in here, and this have a very high potential. Let's make a new branch in here, which means they will fund the expansion for the typical projects. And managers usually use a net present value to analyze and evaluate domestic and international investments project. If the net present value is positive, means the project is highly likely to bring more value and profit to the company, and therefore they deserve the fundings from the parent companies. So this is the capital budgeting, deciding which project should receive fundings. And then managing currency risk. As we all know, in international situation, there are many currency transfer happening. So some guidelines for international financial managers to minimize the currency risk, because currency risk cannot be avoided, they can only be minimized, because it's always happening in daily activities. So first is they need to seek expert advice, could be from banks or consultants, to set up programs or strategies in order to minimize the currency risk. And then they need to decide on what level of risk the firm, the company, can tolerate. And then to monitor changes in key currencies, so they need to really monitor what are the changes happening right now and what may change in the future, to help reducing costly mistakes. So monitoring long-term economic and regulatory trends is also important in predicting what future change may happen. And then the last one is emphasize flexibility in international operations. So they want to make many operations, many activities in international situation to be flexible, so that they can benefit from favorable exchange rates, or they can benefit from unpredicted change situation, because the operation is quite flexible to the changes. And then the last one is managing the diversity of international accounting and tax practices, because financial statements in international companies may be different depending on the country where the companies are located. So some companies some companies located in specific countries, they don't have to show a very detailed or transparent financial statements, but some countries require many international companies to be very transparent in their financial statements. So some countries have high transparency regulation in revealing companies' financial statements, such as the income statements or the balance sheets and something like that. And this, as a result, has attracted greater foreign direct investment, which benefits many companies within the countries. And there is also harmonization trend. Harmonization trend is a trend where international companies attempt to use International Financial Reporting Standards, or IFRS, in public company accounting. This harmonization aims to increase efficiency and reliability in financial reporting, increase the transparency and decisions made by the investors. So when the investors in many countries see the financial statements, they can really have a very good picture of how good this company is, and therefore they may invest, or it may happen in foreign direct investments, which may benefit the companies that use the international standards of financial reporting. And these are the six key tasks of international financial managers in order to make the company gain profit as much as possible. And that's it from me. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.